And we are live. And Laird is on the road, making a road trip, a little road stop in Omaha, Nebraska. Counting Crows, great song. You guys remember that one?
I do.
There you go.
I do.
So, Rob, you a Counting Crows fan?
Some of their songs. My brush with Counting Crows though was I went to a Stanford and UC Berkeley. Stanford Cal and Cal are somewhat football rivals, and they have a big game every year, like so many other schools. And I went to a alumni reception, and we were all just kind of sitting around this courtyard. And suddenly there's this little. This is like 20 years ago, 30 years ago, and there's this you know motion, and I look up, and there's Adam Durowitz. What? Not Adam Durowitz.
Adam Duritz, I think it was. Yeah.
Yeah. Walking through with a buddy on their way to the game.
Oh, interesting.
And he's definitely, when you see him, you would recognize him.
Yeah, because he had the dreads. He dated Jennifer Aniston and Courtney Cox when Friends was in its peak. That was like kind of his claim to fame. So
Wow, the things I learn on this show are just
right.
uh, amazing.
So
Really?
yeah, I swear. I mean, unless I
Some
got
of these guys, Rich, I gotta tell you, like Pete Davidson. Anyway, I'll stop there.
got a Pete Davidson story, this could be more entertaining than the mortgage industry.
No, but I think he's dated some remarkable
Oh,
people.
okay. Yeah, I've heard that about Pete. Yeah. So there you go. And Bernard, you are in the home office in Iowa.
Yes, sir. Des Moines, actually Urbandale, Iowa, specifically. But yes, home office.
All right. Good stuff.
Yeah, Rich tells people he's in Cleveland, but he's actually in Twinsburg, so it's probably something similar.
That's right.
Yeah, I mean, I have this virtual background. I mean, I'm not really in Cleveland every week. I like to portray, man of the people, middle America, grinder. So it's all just a ruse. Rob knows it's not.
Yeah.
All right, well, let's go ahead and get into it. This is The Big Picture. I'm Rich Swerbinsky with Onward and Upward Consulting. On our show is presented and sponsored by our good friends at Depth, the public relations, strategic communication, brand management experts for a couple decades now for the mortgage industry, fintech space, and great partners and friends of this show. So we want to thank our friends at Depth. And this week, as always, joined my esteemed colleague and co-host, Rob Chrisman. With your lamp hat, somebody mentioned that, Rob. It does kind of look like that lamp is a hat. Somebody suggested branding that, maybe with the Chrisman LLC logo or some other logo of your choosing. No?
No.
No, okay. And this week, very, very pleased to be joined by the husband and wife duo, the brain trust and founders of iEmergent. It is Laird and Bernard Nossuli. Laird, good to see you. Thanks for joining us from the road. Excellent. And Bernard, good to see you.
Hey, thanks, Rich. As they say, long time listener, first time caller. Happy to be on the show. This is great.
Yeah, Laird and Bernard have been very loyal consumers of this show, going back to when I had a different name back when I was at TMC. And it's great to have you guys on the show. And I'm excited for the conversation because guys sitting on a lot of really great data, intel, and insight about the mortgage industry. And I guess why don't we start there? And I'll let you guys decide who gives the narrative. But I guess just tell our viewers and listeners a little bit about your unique and cool company.
That one.
So my little elevator pitch is we are a forecasting analytics and advisory company. We let mortgage lenders know where mortgages are going to happen anywhere in the US, from states all the way down to census tracts, and then how to capture that opportunity. So how to execute against that information.
Sounds like very relevant offering in today's mortgage climate, and excited to get into it. So, and Rob,
Bernard, how much do you know about census tracts?
Quite a bit. What would you like to know?
How are they derived? What is a census tract?
So a census tract basically is a geography that accounts for between 2,500 and 10,000 people. So it's a way of I think it's the FFIEC that's involved in creating these census tracts. Maybe
Census.
the census. Okay, thank you. Census. I know we get the information from the FFIEC for that, but it's just a way of being able to say, hey, this is a group, or this is a neighborhood, or this is an area that's similar to each other.
You know,
I think
one of the things that I follow or I write about, and then every time I write about it, people complain about it, and I get tired of getting lambasted via email. But I write about storm damage and natural disasters and the climate and catastrophes, etc. And the real estate and mortgage world has really lagged versus, say, the insurance world in terms of looking at more minute data besides a census tract. They will look at, the side of a condominium complex where a certain condominium will be, and the insurance companies analytics will adjust the insurance based on that, or based on where the unit is in relation to the rest of the units or a particular home. So whereas we kind of look at, we base our servicing values on state, like, I don't want to do business in New York because, nobody wants the servicing. Um, Insurance companies drill down much deeper, and it sounds like census tract is somewhere between the two. So thank you for that explanation.
and I can add that the reason I think that they don't go deeper is because they need to keep it big enough to anonymize the HMDA data. So it would be great if they could get down to that block and block group level, but then I think it becomes too easy to, I guess, in some ways, back into who potential consumers might be if they go to that level of detail. That's my understanding for why they stay at that, 5 to 15,000 or 5 to 10,000 person space. So
And
Thank you.
great unintentional segue, Rob, about, bad data. Like we could work right into the Fed. And they and now Powell 13, I think we're on now. This is now Powell is safe. Rob, you know that I took that news hard, but Trump now saying he's not going to fire Jay Powell after there were some CEOs that came to the White House, Target and Walmart and a couple other big ones, and the stock market not performing great. So the president he's amended his strategy. It feels like, at least for today, with the Fed chair. And any thoughts on the latest trials and tribulations? I know how much you love this. The Trump Jerome Powell. I guess it's not a back and forth. It's completely one-sided. But
Exactly. It is completely one-sided. And frankly, I wouldn't want a boss that calls me, a loser to the entire world economic community. And then the next day say, oh, well, I take it all back. I'm not going to fire him. I mean, that would be just a very difficult situation to be in. I thought, and I bet you could have placed bets on it overseas, but there was probably some bet that you could place on Jay Powell actually just resigning when the president of the United States
it's plus
wants.
140, plus 140. I've got some money on it, actually.
Is
Yeah.
that the deal? But it's a very difficult situation, and I think the feeling is that to your point about data, you know, the I don't know if you really want the Fed trying to predict anything. I mean, I don't know if you look at, and I don't know if Mike Tony from the NBA is on this call, and even if he were, I would say this, but the NBA, for example, has, a team of talented people making predictions that are constantly wrong, right? And they laugh about it, and so, but the industry kind of looks at, says, oh, the NBA thinks we're going to do 2 point whatever trillion, and then they scale it back to 2 trillion and so forth. I don't know if we want the Fed making predictions on future data in order to chart what they are doing in terms of interest rates and setting interest rates. So it's a tough situation all the way around. But I'm a firm believer in the Fed's independence and not having the chairman of the Federal Reserve at the beck and call of the president of the United States, because in general, presidents want lower rates because it spurs growth and makes them look better in terms of GDP. But we are dealing with Trump and changing tariff policy, and that's, if you're the Federal Reserve, I mean, it is a very reactionary position given some of the things that have come through the administration in the last 3 months. So tough. It's a tough position, and capital markets people have to try to hedge a pipeline and try to hedge a bunch of 45 or 60-day rate locks in this kind of environment. It's tough all the way around.
And the other big news of the last week, big time layoffs at the CFPB, and then a judge stepped in, I believe, to put a temporary halt to that. I believe is still in place. But I think regardless, how that all shakes out, we're going to see certainly a seriously diminished and streamlined, I'll use for lack of a better word, CFPB going forward. And Laird, I'll start with you, but I'm interested in everybody's thoughts on this. Rob, and your email inbox and trials and tribulations as well, would be interested to hear what you're hearing. But something I've been talking about it on LinkedIn a little bit, and I think that the general feeling is that that no CFPB could be a tougher situation to deal with than having a CFPB. And we're already starting to see it, right? The state of Ohio, a red state, obviously brought allegations, charges against UWM for redlining is the wrong word, so nobody sue me, allegedly, but higher priced loans without options. And it's just, I think, generated a lot of debate in the industry about, if that this is a good PR opportunity. Housing affordability is a huge issue. Nobody's sympathetic to mortgage lenders. We know that, being in this industry. So kind of a good move. So Laird, I'll start with you. Your thoughts on just the landscape. I'll say post CFPB, it's still there, I guess, but your thoughts on just all that broadly.
Well, I mean, I think that the CFPB definitely, is important and has been important in establishing credibility. And so I think that what we're hearing from, at least from our clients, they don't necessarily like the direction it's going. They didn't want more regulation. They wanted to ease up. But to your point, I think that they look at a world without it, and that's uncomfortable. And so, like, how it's really playing out, I mean, there were a lot of changes, obviously, not just with the CFPB, but with, different choices with Fannie and Freddie and the special purpose credit programs and things like that happening. But what we've seen is that, if you're not going to have, that oversight, or, if this is about changing terminology, the activities that need to be done are going to be done anyway. And the good news, I think, for all of it is that, when we look at the data, what we really see is that growth aligns with equitable housing for everyone, whether that's, if you're focused on, income, if you're focused on race and ethnicity. It is good for our industry to have more home ownership. And I think that, what I've heard in terms of what was the kind of the role of the CFPB, to your point, one thing is at least it standardized it. Now there are going to be potentially 51 different policies that have to be followed. And you can look at Massachusetts and Illinois already have some pretty strict, CRA regulations. Now there might be, lots to keep keep at the top of their mind. But in general, I think the most important thing for us, and what we certainly talk about is that the role of opportunity, and how is sort of, the changing world that we have, how can we leverage that so that we always have a path to growth? And I know we'll talk about data down as we get going through this, but the reality is that when you look at where, the American home buyer, like who is the face of the home buyer pool, it is changing, and it's agnostic to who's in what administration's in the White House. Change is happening. And lenders can either be thinking about that and be prepared for it, or they can sit back and wait and, miss out on an excellent opportunity. And so that's how we've sort of reframed, a lot of our discussions, because, the home ownership, closing the home ownership gap is a big part of our purpose. And I don't think that these two things have to be, it's not it's not an either or. We can have a good regulatory environment that's positive and healthy. We can do good things in communities and have a good business. It's just a matter of how do we leverage data and different things to do it that way effectively and efficiently.
Well said.
And I just wanted to clear up that for those joining late, Laird's hands are not glued to her head. She's in a gas station and she's having a hard time hearing. So.
Well, and going to the chat, we had the chat, some comments in the chat already. Why were you talking about Counting Crows? Because Laird is in Omaha, the famous Counting Crows song, and Shauna Benner from Success Mortgage Partners used to live in Urbandale, Iowa. So, are you guys Hawkeye? Are you guys Hawkeye faithful?
So we both grew up in Maryland, and as soon as you move to Iowa and you cross the border, they put a gun to your head and they say, pick a side. And so we went with Iowa State, and to the chagrin.
Well, we're what we call a split household. My grandfather went to Iowa Med and my sister went to Iowa Law. So I can also take that path if need be, if we have, Hawkeye fans over or within, 10 feet.
You can fit in, with any crowd, right? You can adapt your strategy. There you go. So, Rob, your email inbox on the CFPB regulation in general issue. I'd love to hear what you're hearing from the people.
Oh, you know what? What? How about Bernard go? Then I'll chime in.
Okay, Bernard.
For the CFPB, you said something interesting. Actually, I wanted to touch on, Rich. I think it was in a LinkedIn post that you said, "Hey, no CFPB is going to be actually, attractive for those companies who might have less than honorable intentions." But what was your point? What did you follow up with? You said, "Hey, maybe that's not the case."
And my point was that, I was kind of being honest, like in my head, like the CFPB going away, all these dramatic shifts we get when the White House changes from D to R, R to D. In my head, I'm thinking this is bad for our industry because you need a watchdog in this industry. I just know that this industry's track record on regulating itself it speaks for itself. But the point of the post was kind of like the more and more I think about this, the more I talk to people, I realize I was wrong. That, when I talk to business owner clients of mine, they're like, this is horrible. Like, oh my, you don't know what's coming. We're in New York. We're doing business in California. Like, we could be getting hit with the left, the right, the uppercut, the jab. At least the CFPB, quoting somebody else, the enemy, right? Realistically, if you're not a huge IMB, and are not doing egregiously horrible things, the chances of any CFPB, there's been none of it. Let's just be honest, right? I mean, since the CFPB was created, it's been all big companies or really egregious RESPA violation stuff in our space. So that was kind of my point, was that, I come around to it's better for, it's worse for bad actors, I guess.
Yeah, agreed.
And Rob, your email inbox? What say it?
Well, before we started the show, I was actually writing tomorrow's opening paragraph about this very topic, coincidentally. And at the peak, the CFPB had about 1,700 employees. There's talk of laying off 1,500 of them, taking the staff down to 200, and focusing on actual harm done to consumers, which, on the surface makes sense. But I am not I'm a fan of the existence of the CFPB and the body of the CFPB. I'm not a fan of some of the methods that the CFPB has implemented to restrict the industry. So the original intent of the CFPB was to find harm, consumer harm, create a solution with input from the industry, and then map out a game plan once again, with input from the industry. And it's not only our industry, maybe it's, health insurance or car insurance or payday lenders or whatever. So we only see the residential mortgage segment of that. Depending on who's been in charge of the CFPB, Rich, this hasn't really happened. And we in this pendulum that no pendulums don't stop in the middle. We're either way on one side or way on the other. And I think of the CFPB directors, Kathy Kraninger has been arguably the best because she did try to have industry input and map a plan out and so forth. And there were enforcement actions during her tenure as director, but the CFPB has unfortunately followed the path of politics, and it hasn't really reduced compliance costs. And the interesting thing, and I'll finish with this. The interesting thing is supposedly many people have already left the CFPB and gone to work for state regulators. And if you're a Rocket or a Union Home or Fairway or Gill, or you name it, you don't want to be dealing with 50 mini CFPBs that are out there. Interestingly enough, the states oftentimes would contact the CFPB and try to get some clarification on certain regulations, ability to repay, whatever it is. And what if those states are now calling the CFPB for direction and there's no one there to pick up the phone? And so it's not a good situation. I think you could say that people I hate speed limits. I hate speed limits. Why are speed limits? I don't pay attention to speed limits. Well, you should, because arguably the CFP or the speed limits are there in order to keep us safe and pedestrians safe and bicyclists safe. Um, and if I'm going the speed limit, fine, great. I'm not worried about being pulled over by a cop. If I'm going 60 in a 25-mile-an-hour speed area, then I deserve a citation. There are companies out there who there's plenty of finger pointing that still goes on, like, Rob, can you believe XYZ is doing this, and talk about that and so forth and so on. There are companies out there that are doing things that arguably are detrimental to consumers and detrimental to us as an industry, and they deserve to be reined in. But for the most part, lenders, I would say, are much more compliant than they were and don't have to worry about the CFPB. They would like to see better regulations, not more regulations, and they don't want to go back to 2006. So
It's
my
going to
two
be
cents.
weird. It's going to be weird because, and certainly on the federal level, regulations are going to come down for sure, especially in finance, our world, housing finance. It'll benefit the depositories more just because a lot of it is going to be related to holding assets and holding cash against assets and other things that can bring down the cost to originate. It will also help the IMBs, but it does set up a situation where, like, I could just see, IMB's 83% market share last year. Crazy, right? It was 70% depositories like not that long ago, right? Like 10 years ago. And you wonder if the climate going forward, I think that depositories will pick up market share regardless, and regardless of who would have won the presidency. But it could be a climate where depositories, really do pick up some market. You can see the big banks get back in the mortgage with both feet. It's going to be interesting to see how that all plays out. So, and
Well, in my commentary today, I talked about bank and credit union mergers and acquisitions. The
yeah,
largest credit union in Minnesota is merging with the largest credit union in Colorado.
yeah,
And then you've got Pacific Premier Bank being purchased by the owner, the holder of Umpqua Bank in the Northwest. And so the big are getting bigger.
yeah.
And you know, I see that definitely continuing.
Some good stuff in the chat. Gemma Paciano, the excellent CIO of Legend Lending, she runs the operations for them, and 51 different state regs to manage to, lots of money, questions, wasted time. This is somebody that's doing it on a daily basis. So from the trenches, and a Maryland expatriate, Sylvia, echoing your guys' statement about Maryland expatriates, and Deborah G also noting that mortgage regs related to loss may go down to the county level in some states. So even a little bit more murky, but anyway, good stuff. But I want to get into the data. You guys are sitting on so much really incredible data that I'm just interested to hear your perspective on data becoming such a huge part of our world and our industry. And I'll start, Bernard, with you with the question. In your opinion, the biggest disconnect between national housing narratives and what your data shows you?
Yeah, I mean, I did a quick analysis of the top 111 MSAs that were over $2 billion in purchase volume last year. So on one end, we have, if you want the coldest markets, like a Killeen, Texas, that dropped 6%. So 6%, a 6% drop year over year was the biggest drop of those 111 markets. So not that much, but interestingly, in those top markets that shrank year over year, eight of the top 11 are in Florida.
Interesting.
So we have Naples, Crestview, Northport, Deltona, Lakeland, Pensacola, Palm Bay, Tampa. So all of those dropped. Conversely, some of the hottest markets that are over 2 billion, you got 5 out of the top 13 that are in California. So you got San Jose leading the way with a 25% growth rate year over year. You got Fresno, 16%, Bakersfield, 13%, Stockton, 13%, Sacramento, 12%. So really, it depends on where you are. It's really, it goes to the point that mortgages are local, or in this case, regional. We're looking at different areas of the country reacting in different ways when it comes to some of that information.
No Ohio or Iowa cities in those explosive growth markets, no?
You know what? Dayton,
Dayton.
plus 12%.
Oh, wow. That's interesting. Dayton.
There you go.
Steady as she goes.
Steady as she goes. And Laird, Rob, and I agree with them to some degree, doesn't like the word crisis. It's always says it's overused in our industry, and I generally agree with them. Are we in an affordability crisis in America?
I would agree with Rob in that I wouldn't call it a crisis. I would say that kind of what Bernard was saying, lending is local, it's hyper local. And if you're looking at affordability, there's the side of affordability for lenders, and there's how does affordability impact lenders, and how does affordability impact home buyers? And a lot of that answer is it depends on who you are and where you are, kind of like what Bernard was saying. But the interesting thing is that when you really dig deep into the data, down into the, I love that Rob brought up census tracts, because that's kind of, neighborhoods, that's what we're looking at. Opportunity is everywhere. It's just knowing it, finding it, quantifying it is what's difficult. And, it's a geographic thing, but it's also sort of an idea of saying, okay, if there's opportunity, what kind of loans, is there a lot of opportunity for, what is the demographic of the household? There's so many different pieces so that it's a geographic look, it's a breadth in terms of market segment look. And I think affordability is a challenge, but I think this is when an industry is faced with challenges like that, the two options are keep doing things the way they've always been done, which I'm not a big fan of, or you say, okay, so this is a real issue. And if you look at like even the HMDA data, you see the increase of DTI and down payment as increasingly the driving forces of denials. So that it's a challenge, but it's like on the innovation side, what can we do to change affordability? There's a lot of people, and we've talked a lot about what they call mortgage ready households that don't know who they are. How do we change the definition of mortgage ready? And that's where I think the, discussion should be about, as we see things changing in terms of cost, It certainly isn't helpful if rates stay high. It isn't helpful if some of these markets that Bernard talked about, that increase is driven by an increase in average loan size, not so much by unit increases. But the question is, how do we look at these really complex problems and figure out how to chip away at the different parts of the problem? I think it's an opportunity for the industry to do things in a more efficient way and do things differently. So I wouldn't use the word crisis. I'd use the word challenge. But I think these are the kinds of challenges that we're going to face from here on out as data and wealth and people become more mobile.
Yeah.
Does that make sense?
Yeah, no, it makes perfect sense. Very well said. So this is the big picture presented and sponsored by our friends at Depth. And as always, joined by my esteemed colleague and co-host, Rob Chrisman. This week, Laird and Bernard Nossuli from iEmergent. And
Is this what you guys talk about at dinner?
Yes.
Yes. I
Had to
would say
ask.
that our children know way more about the homeownership gap and a lot of the different pieces and what lenders do. They know a lot about different lenders. We talk about this, would you say, Bernard, 85% of the time?
Yeah, that's lowballing it.
And Laird, I mean, your journey and path guided by your father, great story. Your son, one day, he's a teenager, right? So I mean, he's got to be like
Mm.
right now, like no, but as he gets older and matures, with a chance, does the lineage follow on?
Well, I think children are very skeptical about whether it makes sense to be entrepreneurs and have a small business.
Yeah.
I think they think, I was asked once, why aren't you a radiologist? And I turned out because I don't like radiology. And so I think that they look at it and they see in it, Rich, you know this too. You live and breathe your business when it's a small business. You have it. You don't just throw everything into it. You throw your whole family into it. And
Yeah.
so I do think that they like that loyalty. I think they've seen, it's kind of like we talk about what I want the industry to do. I think they've seen us pivot a lot. They've seen us take some hits and just keep on going. So I think in that respect, it's a good thing. I sometimes wish that they had, there was less uncertainty around it. But so far, I don't necessarily see any of them stepping in our footsteps. If it were really easy for them, maybe they would. I do see my daughter, probably more than my son, getting really interested in some of these issues of equity and, how communities are built. So we'll see if that goes anywhere, but she's only 12. So a lot to happen before that.
A lot of runway left there. So, Bernard, we've seen the last 20 plus years in America, just the demographics of the.
Wait a minute. Rich,
Mhm.
what about your brood? Are they following? Are they going to go into the sports card business? Are they going to go into the mortgage business? What's the scoop?
It's funny. I
kids,
just
right?
got my son. My son he's finishing up his sophomore year at Ohio State this year, and I just got him. Union Home. He's got an internship with Union Home this summer, so he'll be working for Bill Cosgrove, and he'll be on the secondary marketing team, which was I got into that like 19, 20 years old. My upbringing was in secondary marketing, so and actually, my son when I was building the cardboard jungle, it was his senior year of high school, and he helped me immensely with it, especially the video technical parts of it. And it caused him, he was going to go medical in college, but he decided to not go that a long 11-year route and just to get a 4-year business degree because it really did inspire him because he wants to get into the workforce. So,
There you go.
so we'll see what happens. So,
Yeah.
And Rich, I should mention that about, I'd say 85 to 90% of my son's income or what money he makes goes to sports cards.
yes,
So,
thank you.
so maybe you are looking for
He's a
an intern
regular
for
of the
the summer.
cardboard jungle. That's why I brought him up. So your husband as well. So they're both
Yes, he is.
loyal jungle fans. So, Bernard, the changing demographics in America, obviously big shift the last 20 plus years. By proxy, the demographics of home ownership, obviously also changing. Would be curious your insights, the most notable things there for lenders and our audience to know.
Yeah, I mean, this has been this obviously we live and breathe this, but it's a good fact to kind of reinforce is Hey, the home ownership disparity, the home ownership rate between white and non-white borrowers there's at least a 20% gap, 15-20% gap depending on which group, but especially between white and black borrowers, we're looking at almost 30% gap and in 2021. In 2023, it's at 28.6%. And those metrics are even worse than they were when fair housing laws passed in 1968. So, for this to get better, it's going to take all of us. It's going to take all institutions, LOs, everyone involved in order to, bake that bigger pie that Laird was talking about when we say, hey, it's good for everybody. It's good for all businesses and borrowers when we grow the pie together and there's more opportunity for everyone.
And
That's an interesting statistic. I'm going to look at that. So fair lending came along, you said 1968,
Yep,
and the difference between black and white home ownership is greater now than it was then.
that's right.
man, that is a sobering statistic. Think about that, man.
There again, it's very local. The widest gap is in Minneapolis. It's a 51% gap between the non-home ownership or the non-Hispanic white home ownership rate and the black home ownership rate. And you can go across the country, and that's sort of that, not just black, but just all minority or BIPOC, or however you would like to identify, multicultural and diverse households. And I think the challenging thing is that it took, these are not simple issues. It's not simply something that lenders can just change by themselves. And, I'm really involved with convergence in the 3 different cities. I work with BHI in Seattle. And what you really start to think after you really start digging in and looking at this, these are problems that have been around for a long time and are very complex. And unfortunately, complex problems have complex solutions. And again, you mentioned sort of how, how can this be an opportunity, and what are the pieces that need to be brought up. But with these complex problems, even if you go back to how like one particular lender is dealing with it, there's no simple one-sided solution. We like to talk about 360-degree solutions. And we see lenders will think, okay, well, if we want to improve, let's say we want to increase our lending to Hispanic borrowers or households, we'll just hire a Hispanic loan officer. And then there are others that think all we really need is a really good down payment program. Those things done on their own don't work. It's when they come together. And what I've learned, though, is even if all that is happening from the lender perspective, you throw in zoning, you throw in the differences that exist in just the way that cities are or communities are, and it really becomes complicated. And that's where like inventory becomes an issue. So it requires everybody in housing to kind of come to the table and say, how are we going to reframe this? What can we do differently? And I think the good part of that, though, is that if we are doing that thing and we're increasing home ownership, we are obviously increasing the originations that we get every year. But by that changing and reframing how we do it, we can probably we should see increases in efficiency, increases in profitability, because the same problems are kind of causing both issues.
Yeah.
When Bernard and I look at what our purpose is, we see that home ownership gap, and closing it's important. But we also look at the MBAs. You can look at mortgage lender profitability over time. It's all over the board. It makes sense for revenue to come up and down, but profitability shouldn't be that volatile. And those two things together tell me that things are not necessarily being looked at in the long term, that we're making decisions that are good for tomorrow's transactions and not thinking about where are we headed. And when we talk, I like to say, we're running a marathon and a sprint at the same time. And these are real challenges for the lenders. And that's where I do think IMBs have a different situation than the depositories. The depositories have a business model reason for building communities and for being there like throughout the time, because they're selling other things. And that's one of the reasons that, we've seen as a response to this, we've seen very little change and how they're doing things from the depositories. They're doubling down. They've got the same plan because being in their community is a part of all of their business. you look at IMBs, if you think they're only interacting with a particular home buyer every 2-4 years at the most, there's a different reasoning behind why, how and why to connect and how you stay connected. And we're really seeing that in play right now. So you mentioned that you think that it's an opportunity for the depositories to gain share. And I think with the changes in the regulations and just that piece, I definitely see that being really true.
Love it. Bernard, the clients of yours that do the best job weaponizing, using your data to produce actions that produce better results for them. I know that's a complex question, but broadly, it's, characteristics of those lenders.
Yeah, I mean the basic playbook, if you will, is take a market that's of importance to you, and then look at where your branches are and where you are lending, right? And immediately when you see that visually, you can immediately see gaps in coverage. You can see where there is untapped opportunity in your market. And so from there, you can do three things. Number one, you can reorient your existing LOs. Two, you can recruit new LOs and show them, hey, we're going to put you in this area because that's where we know where the opportunity is going to be. And then, three is, okay, or maybe does it make sense for us to open a branch in this area? But the point is, you look at each of your markets and the opportunity within, and then how to capture more of that business. Going deeper into your specific lending strategy and your approach to each market.
Love it. And lenders using data so much more than even just a few years ago in our industry. I mean, even, lenders that are small and what I would consider not sophisticated, never really a thing of the past, but something everybody's kind of looking at now. And, predictive data and analytics, Laird, would be curious to just your take on that piece of our market, using predictive analytics to help shape business strategies, business models, where predictive analytics is at, and where it could be going with the continued advancement of AI and other, kind of emerging tech.
Interesting because, my dad founded the business utilizing our forecast, and we've been doing, I think back then it'd be pretty rudimentary predictive analytics in 2000 and up through the crisis. We were just forecasting, trends more at the metric, the MSA level, not digging into the neighborhoods and the tracks like we do now. But I think what we've seen, kind of happen is it took a while for that. That by itself didn't work. One of the reasons that Bernard and I have seen growth in our company and why we've changed sort of our platform is that you really can't look at the future without looking at the present and the past. The markets are like people. Who we are right now is influenced by where we came from and where we're headed. It's the same thing kind of with markets. And so the way that predictive analytics, I think, is moving is exciting because it starts thinking, okay, when they're predictive, they also have to be descriptive and diagnostic and prescriptive. And with AI, we're bringing in the ability to combine and blend so many more variables so much more quickly. And where we're looking at it, we know our forecasting model is good. To be honest, the accuracy of our forecasting model has very little to do with how much, it's accurate, but that is not why lenders are doing better with it. It's because of how they're using the data and how it's changing their thinking. Piece where it's hard is that the thing we're always asked is, okay, we know this data. How do we create a playbook? What does a playbook look like? And where we're looking at predictive analytics for us, but where I think it can be utilized is how do you take the numbers and then how do you take lessons learned for what works and what doesn't and use AI to start coming up with locally relevant strategies that can be put in place by lenders that are national. So I think that where it's headed in my mind isn't in getting better numbers, is in being able to communicate action more clearly. And that's what makes me excited about it. I was very anti-AI about 2 years ago and then started using Otter for my own, I don't always make a lot of sense when I talk. And when I looked at it, I was like, well, that's something I could tell someone as a strategy. So you take that idea of all these different ideas being bounced around, but then the result is 1, 2, 3, 4. That's a great way for people who are having trouble knowing what to do with data to get started. And that's what I think is exciting, from my perspective.
Bernard, any underutilized metrics that lenders aren't looking at that you wish they would more because they're impactful?
Yeah, absolutely. We always look at what we call the loan penetration rate. So essentially, it's looking at a lender versus a market. So how many loans in that market, for example, are FHA loans, right? And of that, what is so it's FHA loans divided by total loans. That's the penetration rate of FHA loans in the market. And then let's look at the lender's penetration rate in FHA loans. What are their total loans what are their FHA loans as a percent of their total loans? And you compare the two, and depending on, the market, hey, does it make sense for us to try to be at the market? Does it make sense for us to beat the market? It depends on the market itself and your lending strategy, but the point is that is very telling to be able to identify whether it's loan type or whether it's the borrower race and ethnicity, whether it's income. Those all apply in being able to pinpoint, hey, how can we tweak our strategy based on this information so that we can get to reach our goals?
Love it.
Piece of that becomes really powerful is when you look at, okay, this is what happened, this is what we missed, but then you look at the gap, and then you look at where that penetration rate is moving, from the market perspective, and it can actually help you prioritize. If there's a gap in a market, whether it's geographic or market segment, that's shrinking, that's less of an alarm bell than, hey, we're losing share in a market that's growing. From a business perspective, that's what makes them sort of wake up and say, you know what, this is just going to get worse. And so what we've been asked about lately is how do you take all that and start, being able to say, okay, that's a red market, that's an orange market, here's a yellow market, so that they don't just have to deal with everything all at once, that they can create priorities to say, all right, what can we have the greatest impact? Where is there the greatest need? And how well situated are we to handle it strategically? And so it's always driven by that. What opportunity is there? What opportunity matches ours? How do we move forward toward that?
Good stuff and good direction for our mortgage lenders in the audience. And check out iEmergent online. We can get you their contact info and you can find them online. Great company that does great things for their clients, run by great people, which always is important as well. So want to thank our sponsor and friends and partners at Depth. Check them out at Depth.
Shout out to Depth.
Yes, that's right. iEmergent Depth clients. And I'm assuming you're as happy as the rest of their clients.
100%.
Love it.
100%.
Great team.
Good stuff. Good stuff. Want to thank Laird and Bernard for joining us this afternoon and enlightening our audience. The insightful conversation. Laird, Bernard, thank you very much.
Appreciate it. Love the show.
Yeah.
Love it. And
I don't watch the show as much as he does, but I love it when I do.
And Rob, thank you as always. Good to see you. Any good weekend plans? Where's your next travels sending you? Omaha? No.
I don't have any business travel, believe it or not, until the national secondary.
Wow,
But,
that is unheard of for you.
I will be in Hawaii for part of that.
Oh,
between
wow.
now
All right. Okay.
So I think I'm gonna sit here and try to remind myself that the Federal Reserve is here to lend stability to the banking system.
Keep telling
and the
yourself that.
economy.
All right. Here we go. All right. So, and I always want to thank our audience. If you are listening to the podcast, where most of you listen or watching on YouTube, join the live broadcast. We had almost 150 people in here live today. Always fun, interactive with the audience. We're live on Zoom. You can go to chrismancommentary.com to get signed up for the live version as well. So until next Thursday at 3 Eastern, have a great rest of the week and weekend, everyone. And we will see you next week. Thanks again, everyone.
Thank you.